we can probably get started as we wait for a few others to pop in, and the beginning part they can continue recording.
Yeah, let's go ahead and do that. Mike, if you want to go ahead and kick us off, that'd be great.
Yeah. So really kind of what Darren and I want to talk about today is just what are strategies, what are things that we can put into place for attorneys just to help make sure that they're paying the least amount in taxes as legally possible. So as we get started here, we just kind of want to introduce ourselves so you kind of know who you're listening from here in this presentation. And my name is Mike Jesowshek. I'm the founder of a firm called JETRO. We're headquartered here in Milwaukee, Wisconsin, and we simply say that just because that's where I'm located. But we run a completely digital and virtual firm, and we've done that since we started our firm 7.5 years ago. So we have clients scattered across the country, and we have employees scattered across the country as well, working remotely. And so we have a team of 10 of us here, and we work exclusively with small business owners, and we focus on law firms, small law firms, and attorneys. And the services that we offer are bookkeeping, taxes, payroll, and tax planning is a key part of our service offering, which we'll obviously discuss a lot of today. I'm also the host of a small business tax savings podcast. So if you're ever interested in just kind of hearing a weekly tax tip and idea, I'll put a link and information to that later in the presentation.
Absolutely. And I'm Darren Wurz. My company is Wurz Financial Services. I'm a certified financial planner. I have a master's degree in financial planning. And my business kind of started out focusing on anybody. And then it just kind of turned out that a lot of my clients were attorneys. And so I decided to kind of, focus more on that, segment of people and try to figure out, what are some of the big issues that attorneys are dealing with and how can I do a really good job of meeting those needs. And I've learned a lot. There are really some very unique things that apply to attorneys that I think attorneys would really benefit from knowing. And so that's really exciting. I've been very involved with the Northern Kentucky Bar Association, doing some different seminars and things like that. And I was really excited to connect with Mike, knowing that Mike is a CPA that specializes with working with attorneys. And I thought that was really great. So, very excited to be here today and share some great ideas with all of you.
Awesome. So to start off the conversation, I'd like to just talk about what is tax planning. What is tax planning entail? And so when we start this conversation, I like to think of this idea of that the tax code was written the way it was for a reason. It was written for that way for us as business owners to take advantage of and utilize to our advantage because that's part of the tax code. So the number one mistake that we see clients face when it comes to taxes is just not planning at all. We see clients that say, we don't want to save taxes because we feel like that's doing something illegal, or we feel like we can't do certain things, or we're crossing that line. And so what we're going to talk about today, Darren, both of ours, is just going to be, here are tax strategies that are 100% legal. We would never advise a client or put someone down a line where it's in that red area. And that is what I want to start to kind of get that idea going with the attorneys on this call is, what are strategies that you can implement in your business to save taxes and know that there's a lot out there for you? And so most business owners, their biggest expense or one of their biggest expenses is going to be taxes. And so a lot of people don't think of it that way. They think of payroll, rent, things like that. But at the end of the day, if you're a successful business owner, you're going to pay taxes on the profit of that business. And so when we think of tax planning, we want to look at it as your key to financial defense. We can implement tax planning strategies and guarantee tax savings. Now, on the financial offense side, financial offense would be doing advertising dollars, getting more business, increasing revenue, which is of course necessary, but there's no way we can ever guarantee results. We could do a massive advertising campaign, but we can't guarantee that we're going to get business from that. With tax planning, we can guarantee results. We know if we implement a strategy, here are the savings that we're going to make. And so this whole concept of tax planning, we want to think about pre-tax and after-tax dollars. Pre-tax dollars or after-tax dollars would be, let's say you're a normal W-2 employee. You're going to get a gross salary. You're going to get all your taxes taken out, and then you're going to get the net left over, and that's your take-home pay. All the spending that you do is considered after-tax dollars. Any spending, anything you purchase, it's already been taxed. As a business owner, we have the advantage to move things into pre-tax dollars because we have our business revenue, sales, and then we have all these expenses, and then whatever is left over is what we pay taxes on. So when we think of tax planning, we want to think of how can we turn after-tax dollars, items that we typically would spend after it's been taxed, how can we move that into a pre-tax dollar? And so that's a lot of the strategies we're going to be talking about. But I also want to talk about, I mentioned at the beginning that I had an attorney that I was talking to that said, Mike, I don't want to minimize taxes because if I minimize my taxes, I can't get a mortgage and I can't get lending and I can't get things like that. And I said, I think that is just a misunderstanding of what tax minimization is. Increasing expenses, maximizing deductions to lower your income is one way to minimize taxes. And it's a valid reason, and it's a valid way that a lot of attorneys, a lot of business owners do. But that can only go so far. You can only get so much expenses within your business. You're still going to have a profit. And so a lot of the tax strategies we talk about, it's not simply just increasing expenses, so beef up your expenses. We're talking about ways that you can systematically reduce your taxes in a real lifetime. So one strategy that I just want to get started with is this S corporation strategy. And here at JETRO, we have what we call baseline tax strategies. Baseline tax strategies are strategies that can be implemented whether you're making $50,000 a year or $1 million a year. They're easy to understand, they're easy to implement, and they typically don't cost much money to implement. We say we want to exploit baseline tax strategies, utilize them as much as possible. Once we've done that, then we want to look into an advanced tax strategy. And so a lot of what we're going to be talking about are some of these baseline tax strategies. And the S Corp is actually one of the first baseline tax strategies that we implement. So this is kind of our foundation of what we do when we're working with a new business owner is setting up an S corporation. And then we build from there different strategies over and above that. Now, for an S corporation, we normally say you want to have profit of $40,000 to $50,000 or more. If your profit's less than that, most of the tax savings that you get are going to probably get eaten up by a business tax return that you have to file that you don't normally have to file, and some payroll that you have to run that you might not need to run payroll otherwise. So those costs can sometimes eat into the tax savings, which is why we say once you've hit $40,000 to $50,000 in profit, we're going to recommend an S corporation. And the main reason for recommending an S corporation is to reduce self-employment tax. And so on this example here, I have a sole proprietorship or a single member LLC. So if you're an LLC or a sole proprietorship, you're going to be taxed. You're going to get hit with self-employment tax on 100% of your income. So in this example, I have income of $80,000. You're going to pay self-employment taxes of $11,000 on that $80,000. Now this is over and above your normal income tax rate. So you pay your normal income tax rate, whatever brackets that is, plus you pay self-employment taxes on top of that. Now, before I go into the S Corp and why we do an S Corp versus this, I just want to mention that an S Corp is not an entity structure at the state level. You are either an LLC or a corporation at the state level, and then the S corporation is just an election to be taxed as an S corporation. So a lot of people say, well, I've been an LLC for 20 years. I don't want to switch now. There is no switching with an S Corp. It's just an election to be taxed differently. You would remain an LLC. You would keep the same EIN. You'd keep everything the same. It's just an election to be taxed as an S corporation. So here's where we talk about the S corporation alternative. With an S corporation, we take your income and we split it into two pieces. We have a salary piece. So you're required to take a reasonable salary as an S corporation owner. So you'd have to pay yourself reasonable salary. You'd be a W-2 employee of your business. And then we have a dividends or a distributions or an owner's draw piece. That salary piece would get hit with self-employment taxes. So whatever that reasonable salary is for you, we're going to get hit with self-employment taxes on that reasonable salary. But any profit that your business makes over and above that salary does not get hit with self-employment taxes. And so many people say, well, how do I get money if I'm not taking all of my money through a salary? And all it is, it's a dividend, a distribution, an owner's draw, which is a transfer from your business account to your personal account. Simply the way that you would do that if you're not an S Corp now, when you're moving money from your business account to your personal account, it would work just the same way. So again, with an S corporation, we split your income or your earnings into two different pieces: the salary piece and then the dividends or the owner's distribution piece. The salary piece gets hit with self-employment taxes. But the beauty about an S corporation is that the dividend, the owner draw piece, you avoid self-employment taxes on. So I want to go through kind of an example of where this comes. Let's say you're an attorney, you're making $100,000 a year, you have $20,000 in expenses. So you have $80,000 left over. If you're set up as a sole proprietorship, a single member LLC, you're paying your normal income tax rate on $80,000, plus you're paying self-employment taxes of $11,000 on that $80,000 in profit. Now, let's say we decide to move to an S corporation, and we determine that a reasonable salary would be $36,000. We're going to pay self-employment taxes on $36,000, but that remaining $44,000 of that 80 in profit, you're not getting hit with self-employment taxes on. So you still pay your normal income tax rate on all that income, but you're avoiding self-employment taxes. So in this scenario, in $80,000, in just a small amount of $80,000, we could be saving close to just under $6,000 in self-employment taxes. So when we look at the S corporation, that is the number one goal by doing that, is to minimize self-employment taxes that we're paying. Now, there's a whole bunch of added benefits. There's a lot of things that we can add on to an S corporation over and above just that initial setting it up. But the S corporation main purpose is to minimize self-employment taxes. The second purpose is that we use an S corporation is to avoid or to lower our audit risk. S corps get audited less than 0.5%. A typical Schedule C sole proprietorship single member LLC, that audit rate's right around 3.5%. So that's just an added benefit, which you'll find that there's a lot more added benefits as we go. So some clients tell me, Mike, when would be a good idea, or when wouldn't I want to do an S corporation? And we say, typically you wouldn't want to do an S corporation if you were in certain cities or states that they kind of that have a bad rep for S corporations. And this is very rare. So Tennessee is an example. Typically, we don't do many S corps in Tennessee. New York City is an example. Typically, we don't do many S corps in New York City. But New York State and just about everywhere else, S corporations make a lot of sense. So that is kind of our one, again, when we think of baseline tax strategies, which this is one strategy that we oftentimes start out with if it makes sense for a client. As we go deeper into these baseline tax strategies, we can look at all sorts of different things, which Darren's going to talk a lot about and things that we can piggyback with, retirement, things like that. But there's a few strategies I want to talk about specifically that we see clients that come to us not taking advantage of or not even knowing that they're available. So the first one I talk about is hiring your kids. And so a lot of people say, well, what can my kid possibly do in my business? My kid is 8 years old. How can they be part of a law firm? And this is, again, where I want to encourage attorneys to get creative, to think deep about this. Again, if you're going to be paying after-tax dollars to pay for your kids' basketball camps, baseball camps, they want to go to amusement park with some friends, and you're going to be funding that spending anyways, wouldn't it make sense to see if we can find a way to get a business deduction for that and potentially have the child pay no taxes at all? It's money that you're going to be spending anyways. Typically, you're spending it after it's already been taxed. So it's profit. You've been paid taxes on the profit of your business, and then you're doing your spending. What if we can find a way to get it inside the business, get a tax deduction for it, and turn it into a pre-tax spending dollar? So this is where this idea of hiring your kids comes along. Now, with the Trump tax cuts, the standard deduction used to be around $6,000. Now it's, in 2020 here, it's $12,400. So what that means is that nobody pays taxes on their first $12,000 of income. So you make $10,000 of income, you pay no taxes. And so that means that if you're hiring your kid within your business, that they can earn up to $12,400 without having to pay any kind of taxes on that. So again, if we think about this, it's a business deduction. You're getting a deduction in your business, and your kids are potentially paying no income taxes on it. It's a win-win situation for items that you're probably going to be spending otherwise. Now, here's the key point, though. you must pay a reasonable rate for the work performed. So you can't pay someone $150 an hour to shred paper, but as long as we have documentation, it's a reasonable rate for what they're doing. We have documentation of the time they spent doing it, and maybe like a job description of what they're doing. This is a valid deduction. Now, a lot of people will say, what could my kid possibly do? And this is where I say, get creative. Is there social media that they could be doing? And some attorneys will say, I don't even do social media. Well, if we could pay your kid to do it, maybe you're not going to utilize it, maybe not, but it's a way that we can do something and pay your kid for it. It could be cleaning the office, all sorts of things. So I want to say, get creative on ways that we can hire a kid within your business, because this is a strategy that can provide potentially up to $12,000 in tax deductions per child that you have. So something to think about there. This other piece is another tax strategy that we oftentimes have clients come to us that are just not aware of. And this is what we call the Augusta Rule. And so what this stemmed from was the Masters tournament in Augusta, Georgia, is a golf tournament. And a lot of people were renting out their homes for people that were coming into town. And they would stay at their houses for a week, and they would pay a lot of money to rent out this home for the Masters tournament. And so previously, the people that were renting out their home were getting stuck with these tax bills. And so they're like, why are we paying taxes on a 7-day rental? And the IRS kind of looked at it, they looked deeper into it, and they said, you know what? You're right. This doesn't really make sense. And so they created what they call a 14-day home rental rule, which means that you can rent your home out for 14 days or less and pay no taxes on that income. And so what we thought is, instead of thinking about Masters tournaments or golf tournaments or Super Bowls, whatever it might be, how can we utilize this as a business owner? How can we have our business rent our home from us for 14 days or less, get a business deduction, and have no taxable income to us? And so again, this is where we want to get creative and think of, can we have a corporate meeting? Can we have a team meeting at our house? Can we have a board of directors meeting, which your board of directors could be, you and your family, and whoever your board of directors might be. We could host that at your house. So with this strategy, we want to find a reasonable rate. If we want to, what is the average a boardroom cost to rent in your area? Let's say it's $800 a day. Okay, well, that's our rate. If we're renting our house out for 14 days, it's $800 times 14 days, and that's going to be our amount. Or let's say you have a client over that happens to be a friend, but you have a client that's staying over, and we can find a business deduction for that. Well, let's find out what the average hotel is. Let's say it's $250 a night. Client stays over for 3 days. Well, now we have $250 that we can reimburse ourselves, get a business deduction, and pay no income taxes on that income. So again, a lot of tax strategies is just kind of thinking out of the box. How can we maximize this tax savings? How can I avoid paying taxes and implement things like this that I'm still going to potentially receive the money? It's just going to be tax-free in various different ways. So again, that's where I want to put focus on. First off, the S corporation, understanding tax planning. Think about hiring your kids. Think about implementing the Augusta Rule. Again, these are what we call baseline tax strategies. These can be implemented no matter what your business size is, no matter how much profit your business is doing. These are strategies that can be implemented. Once we've exploited these tax strategies, once we've said we've done everything we can in the baseline tax strategies, that's when we can dive even deeper into some of these advanced tax strategies that the really big guys are doing. And so that's really where I wanted to end today with the Augusta Rule, and kind of going through that. If you have questions on this, shoot them in the chat, and I'm going to roll this over to Darren, and we will kind of wrap up at the end together too.
All right. Well, that's great. Great ideas, Mike. I'm learning new things even myself here, listening to this, especially hiring your kids. And I'm going to actually talk about hiring your spouse here in a minute. So stay tuned for that. And then I'm also thinking, my dad just bought a place down in Florida. Let's use that as a company retreat.
There you go.
Absolutely. So you heard some great ideas from Mike on tax savings from the CPA's perspective. And I want to give you some things to think about from the financial planning perspective as well. And I've got 5 different things I'm going to discuss with you that could be potential tax strategies for attorneys and how attorneys can implement those. Okay, so let's start with the first one here, retirement savings. So one of the chief ways that you can reduce your taxes is by reducing your taxable income by using some kind of retirement plan or retirement account. Okay. The most basic type of retirement account is the IRA. And you may already be familiar with the IRA, but just in case you're not, you have two kinds of IRAs. You have a traditional IRA and you have a Roth IRA. With the traditional IRA, money that you contribute to the IRA goes in on a pre-tax basis. So you get a tax deduction for putting money into the IRA. Okay. Now, as long as that money stays in the account, it's going to grow. You can invest it and it'll grow, and you won't pay any taxes on those earnings while it's in there. And then when you reach retirement age 59 and a half, you can start taking distributions, but those distributions will be taxed at your ordinary income tax rates. Okay, so it's kind of like deferring the tax burden until later on. With the Roth IRA, by contrast, the money that you put in, you do not get a tax deduction on. However, so it's money that you've already paid taxes on. It's after-tax money that goes in. Just like an IRA, a traditional IRA, it grows tax deferred. But then when you get to retirement age, the entire amount is tax-free to you. You can take distributions on a tax-free basis and not pay any taxes on those distributions. Now, if you're trying to minimize your taxes today in the present, then you're probably going to want to use the traditional IRA. I like the Roth IRA for younger people that have a long time frame. If you're in your 20s or 30s, you're early in your career, and the money's just going to be staying there. It's going to be invested for a really long time, and you're kind of at the lower income end, but you'll make more money down the road. And the Roth IRA might make more sense for you. However, if you are, in your peak earning years, your 40s, your 50s, your 60s, and you don't have quite as much time, then the traditional IRA is going to generally make more sense. And we've got a software we can use to kind of help you determine which one is going to save you more in taxes, over your lifetime, because you want to think about that too. This is the present, of course, but then also thinking about the future as well. Okay, so with an IRA, you can contribute up to $6,000 in 2020, an extra $1,000 if you are over the age of 50. If you do not have an employer retirement plan or retirement plan with your business, there's no restrictions on getting the tax deduction for the traditional IRA. However, if you are a participant in an employer retirement plan, or you have a retirement plan with your business, there are some income limitations that apply. So you'll want to watch out for those. Now, one neat thing about the IRA, and then there are income limitations that apply to the Roth IRA too. So if you're making a lot of money and you don't qualify for a traditional IRA deduction, or for making a Roth IRA contribution, sometimes what we'll do is what's called a backdoor Roth IRA contribution. And basically what you do there is you make an after-tax contribution to the IRA, and then you flip it over to the Roth. And that's a way to kind of get around those income limitations and get some money into the Roth IRA for you, so you can get some tax advantages. Okay, now, the IRA is not terribly impressive, only being able to put $6,000 away. The simple IRA and SEP IRA give you a little bit more flexibility. So a lot of what we're talking about today is going to apply to those law firm owners. So either if you're a solo attorney, or if you're part of a small group, a small partnership, and there's just a few of you in the organization, then you guys can determine what plan you want to use. And that's really nice, because you can really do some interesting things. So on the most basic level, you've got the simple IRA. With the simple IRA, as the name implies, it's pretty simple. So you can put $13,500 in as an employee, and then your business, your firm, is going to contribute an extra, either a 2% match for what you're putting in based on your income, or a 2% across the board for everybody, or a 3% match. Okay. So that's kind of nice. It gives you the opportunity to put away a little bit more than the traditional IRA. If you need to put away more than that, there's the SEP IRA. The SEP IRA allows you to put up to $57,000 or 25% of your income, whichever is less. Now, there's one catch here, though. All of that with the SEP IRA is employer contribution. So you don't get to make an employee contribution. It's all from the employer. And what that means is that everybody in your firm, owners and employees, is going to have to receive the same percentage of their income. So that may not be necessarily ideal for you. Okay, then you have the 401k. If you really need to put some more money away, you've got your 401k. You may be familiar with the 401k plan. If you're part of a big business, you've got, the corporate 401k. You can contribute up to $19,500 as an employee, and then the employer can provide a match. Okay. The total amount from across employee and employer contributions that can go into the 401k is $57,000 plus an extra $6,500 if you're over 50. So the 401k allows you to actually put away a lot more money. Now, if you're an owner of your business, or a solo attorney, or you're part of a partnership where there's owners and there's no employees, you can do something really cool, okay? You can set up what's called a solo 401k or an owner-only 401k. And doing that is great because it's very easy to do. You don't have to do a whole... There's no TPA requirements or special testing, IRS testing requirements. It's very easy to do. And it gives you a lot of flexibility. So with a solo 401k, you can basically, you're going to put up to $57,000 in there, right? Or an extra $6,500 if you're over 50. That employee portion can be either pre-tax money or Roth money. So that's the very key point. You can determine which one is better for you. The rest of it, up to $57,000, can be either pre-tax money or it can be after-tax money. Now, why would you want to put after-tax money in your 401k? Well, the neat thing about that is you put the after-tax money in above and beyond the 19.5, and then you can flip that over to a Roth IRA. So it's an extra way to get some more money into a Roth IRA for you to give you that tax advantage down the road. Now, another cool thing about the solo 401k is if you can hire your spouse in your business, and if you pay them a salary, right, then they can contribute to the 401k just like you. So really, if you're an owner, if you're a solo attorney, you own your firm, you can really get double that amount. So 57,000 times 2. So you can really pump a lot of money away towards retirement, and you can really reduce your income quite a lot using that strategy. Okay, now I know this is a lot of information, so if you're getting lost with me, that's okay. Feel free to pop a question in the chat. We're gonna have a Q&A session at the end, but and I know this is a lot to possibly take in, so don't worry about that. I'd be happy to chat with you and explain it in a little more detail, one-on-one, if you like. Okay, and then there's one last option. And this one's kind of rare, but it's a great option for law firms and doctor's offices, dental firms too. It's called the cash balance plan. Okay, so the cash balance plan is technically a defined benefit plan or a pension plan. But basically, it allows you to put away a lot more money. Now, it can only be pre-tax money, and the amount that you can put away is a formula based on your age and your compensation. So this is a plan that is going to favor owners usually, because it's going to favor those members of the firm that are older and make more money, okay? And you can potentially put away up to $343,000 a year on a pre-tax basis. I'm not going to get into all the details because it's a little complicated, but that is a great strategy too. The only downside to the cash balance plan is it does cost some money to set it up and to operate it. Okay, so that's retirement savings. a lot of great things there. Now, there's some other ideas too. Okay, and the next one here I want to talk about is the Stealth IRA. Okay, now it's not an IRA, but a lot of people call it the Stealth IRA. It's actually the health savings account. Okay, so if you are an owner of your firm, you may be responsible for choosing your own health plan. Okay. And more than likely, you don't really want to spend a lot on your health insurance. So a lot of people, they go for the high deductible plan, right? They don't really want to pay a whole lot of money on that health insurance, and so they opt for the high deductible plan. If you have a high deductible health plan, you can set up what's called a health savings account. A health savings account is an account you can put money into on a pre-tax basis, and then you can withdraw money from to pay for healthcare expenses tax-free. So that provides you almost really a double tax advantage, because your earnings can be tax-free if then they're used to pay for your healthcare expenses. Now, one of the really neat things about the Stealth IRA is you used to have to use the money up each year, and then they decided, well, you can let it sit and you can let it grow. So, and then when you get to age 65, the Stealth IRA, the health savings account is treated like an IRA. So once you reach age 65, you can take money out of your health savings account for any reason, and it will be taxed at your ordinary income tax rates, just like it would if it was coming from an IRA. So if you're maxing out your traditional IRA, you're maxing out some of your other options, and you're looking for another option, I would recommend, and you have a high deductible health plan, I would recommend setting up a health savings account and maxing that out as well. And you have a lot of investment options with a health savings account too. I keep wanting to call it a Stealth IRA. But yeah, you have a lot of investment options. You can set it up through some of the really well-known brokerage firms like TD Ameritrade or others, and you can invest it just like you would a regular IRA. Okay, pretty cool. All right, let's go on to the next one here. Okay, so we've got retirement savings, making sure you have the right retirement plan for you and for your firm. The health savings account can provide some additional savings. Now, here's one thing that's very unique and applies to attorneys specifically, and that is deferring your contingency fees, fee compensation through a structured fee arrangement. Now, this is pretty cool, and I just started to learn about this a year ago or so. But what you can do is when you receive a settlement from a case, right, you've got a big tax problem. Let's say, you win a really big case, you get $1 million fee, you've got a big tax problem. Number one, because you're going to have to pay taxes on all that money. And number two, because having that much income in one solitary year bumps you up to the highest tax bracket. And by the time you factor in federal, state, local tax, you could easily be paying 40% or more just in taxes. So one of the cool things that you can do as an attorney is you can set up a structured fee arrangement to defer that income and receive it over a period of years. So you could set it up where you're gonna put it in the structured fee arrangement today, this year, and then 10 years from now, you're gonna start receiving it, and you're gonna receive it maybe over like a 10-year period, right? A lot of times this is really helpful for retirement planning. This could be something that you set up to start paying you at age 65. Or you could set it up, let's say you get a really big settlement, you set up a structured fee arrangement that's going to pay you just enough to cover your operating expenses. And that's going to help you with some of the bumps in your cash flow. Being a personal injury attorney or a contingency fee attorney is not very easy. You've got some major swings in cash flow that you have to deal with. And a structured fee arrangement can help you to smooth that out. Now, it used to be that the only way you could do this was through an annuity or some kind of insurance product. In the last couple of years, they have come out with what are called market-based structured fee arrangements. And with a market-based structured fee arrangement, basically, you can, instead of having to use an annuity, you can invest that money directly in a brokerage account, like TD Ameritrade or Charles Schwab or something like that. So that's really nice. I know a lot of people are not really fans of insurance products or annuities, and the market-based option really helps a lot. And I have a little illustration there for you to show you the difference. If you had $1 million fee, you paid a 40% tax rate. Let's say it's 600,000 left over, right? And then you're only putting 600,000 into an account to invest it, and then you're going to get taxed on those earnings. So it's almost like double taxation, because you get taxed once when you get it, and then when when you're trying to make up what you paid in taxes, you're getting taxed on that growth again. Right? That's not fun. So the other option, of course, is to defer it through a structured fee arrangement. And you can take that full amount minus any fees and invest that full amount, and then simply pay taxes. You get a 1099 and you pay taxes when it is paid out to you. So that is really a great strategy for attorneys. I did have a question here that came through from Les. Said, must you start withdrawing from an HSA at some point, like with an IRA? That's a really good question, and I'm going to have to get back to you on that one, actually. My gut tells me probably, but yeah, that's a really good question. If there are, so with an IRA, you have to take mandatory withdrawals, required minimum distributions at age 72. I'm not sure if that applies to the HSA. That's a really good question. Thanks for that question, Les. I'll look that one up and get back to you. All right. So, and there's a couple other things that apply to everybody, but attorneys would probably be very interested in as well. Tax efficient investing. So, a lot of attorneys have a lot of after-tax money, because you want to keep money. Especially if you have irregular income, you want to keep some money that's liquid that you can access. And with that after-tax money, you want to make sure that you are minimizing taxes on those investments as much as you can. If you are, in one of those high tax brackets, you may be paying some pretty hefty taxes on your gains and your dividends. So you want to make sure you reduce those capital gains as much as you can. So take a long-term approach. That's one idea. Don't buy and sell very frequently if you can avoid it. If you hold on to an investment for at least 12 months, then that gain turns into a long-term gain, and you're taxing those capital gains rates instead of your ordinary income tax rates, which is really nice. And the highest capital gains bracket, I believe, is 15%. So that's very, very helpful. You can also take advantage of tax loss harvesting. So towards the end of the year, if you have some positions in your portfolio that have lost money, you might want to sell them, wait 30 days to buy them back, or buy something different. And you can take that loss and use that loss to offset some of your gains elsewhere. Also, you want to look through the holdings in your portfolio and make sure you have investments that are tax efficient, right? Actively managed mutual funds are going to be less tax efficient. At the end of the year, we're getting here soon, a lot of those funds are going to pay out capital gains and dividends to the owners. Index funds and ETFs tend to be really the most tax efficient because they're passive vehicles. There's not a lot of active buying and selling happening inside. Another idea is a low-cost variable annuity. Sometimes variable annuities get a bad name. There are a lot of really complicated variable annuities out there, but there are some what they call investment-only variable annuities. So it's the bare bones annuity with no bells and whistles that is simply set up as a tax shelter. So we have one that we use through Nationwide that's great. It costs $20 a month. That's it. It's a flat fee, which is really, really nice because it doesn't matter how much money you have, you're only going to pay $20 a month. So that's really a great feature on that. I'm sure there's others out there that are equally advantageous. All right. So retirement savings, the HSA account, deferring your fees through a structured fee arrangement, tax efficient investing, and one other idea that a lot of people have asked me about is life insurance. Life insurance can be used as a tax strategy. Life insurance can provide a way to reduce your taxes and, of course, pass on wealth tax-free to the next generation. So, the death benefit from a life insurance policy is tax-free. That's really nice. Also, kind of like a retirement account, inside a life insurance policy, those cash values grow on a tax-deferred basis. So you don't pay any taxes on those earnings inside the insurance policy. So how would you use a life insurance policy as a tax-saving vehicle? Well, what you would do is you would get a life insurance policy. You would overfund it. So you would put more money in it than you need to, okay? And then when you get to retirement, you can take tax-free loans from the cash value that you've built up, and you can use that to supplement your retirement income. So it's kind of like a way to provide yourself with some tax-free income, okay, in kind of a sneaky way. However, this used to be a really great strategy back when interest rates were, 11, 12, 13%. It's not such a fantastic strategy in today's world. There are variable life insurance policies that will allow you to invest in a sub account that tracks the S&P 500 or something like that. So you can get, potentially some good earnings that way. But of course, interest rates are very, very low today. So that kind of hurts, the advantages that you can get here. Also, usually the investment options inside a life insurance policy are very limited, and you can only adjust them once a year. So that's not really the best. And then, of course, you have the cost of the insurance. So if you're in great shape, very healthy, the cost of insurance might not be such a terrible thing. But every year there's a charge to the cash value to cover the cost of the pure insurance amount or the death benefit. So it can be a little bit more costly of a strategy. All right. So we went through a lot of different ideas here, and I'm going to send it back over to Mike.
Yeah, no, that was excellent stuff. And at the end, as we're going through Q&A, I'll touch on some of the things you talked about as well. But what we have here is just some next steps. We have a Facebook group on our end. So if you're looking to get into tax ideas, ask questions, kind of interact with other people in a similar situation as you are, just search in Facebook, Small Business Tax Secrets. It'll pop up, send a request in, and we'll get you approved. Again, we do a weekly podcast episode. So on our podcast, where it's usually about 10 to 15 minutes long, sharing a tax tip, an accounting tip, something in that sort. And it's a weekly episode. They launch every Wednesday. So definitely check that out. It's called the Small Business Tax Savings Podcast. Any podcasting platform you search, you can find it in there.
Very good. Yeah, that's a great resource that Mike has created. So make sure you check that out. I'm not quite as talented as Mike on the podcast thing, so I don't have one of those. But we do have a Facebook page where we post updates and things. You can check us out on Facebook. And then we do have a blog on our website. You can get on there, wurzfinancialservices.com/blog. And we put a new blog topic up each month and try to keep those nice and relevant. A lot of great topics for attorneys and others.
Awesome. So here's just some kind of final contact information if you want to reach out to us. It's on the screen, but really kind of what we wanted to focus on too now is questions that you guys have. So feel free, after kind of what we discussed, what we've talked about, send the questions over in the chat. I just want to talk about some things that Darren mentioned, which I think are really good. And that's a lot of times when we're talking about doing an S-Corp, having a business, we're adding on a retirement type plan, many of the ones that Darren mentioned. And then he also mentioned hiring your wife. And so or spouse, wife or husband. And I just want to touch slightly on that because a lot of people say, should I hire my spouse in my business? And really what we tell them is that there's only 2 times that you would ever want to hire your spouse in your business. And the main reason we don't want to is because they're paying self-employment taxes on that salary you pay them. So you hire your wife or your husband, you're paying self-employment taxes on that income that they have. And so why pay double self-employment taxes when you could just give yourself a reasonable salary and then take all the rest in draws or distributions or dividends and share that obviously as a family. But there's two cases where hiring a spouse does make sense. And it's what comes down to a retirement fund. If you want to, as Darren mentioned, kind of max out 2 retirement accounts, that's a great option and a great possibility to do it. Or if it comes down to some type of health issue. So if you have high health costs, there's ways that we can hire and work a spouse into a business to help get those high health costs done as a business expense.
Yeah, that's a really great point. The self-employment tax, yeah. So you want to really kind of evaluate all of that, and that's why it's important to have a really good accountant like Mike to weigh in on these things too. That is one disadvantage to hiring a spouse. So you want to, check that out and kind of see, is it going to be worth it for you? Yeah, very, very important consideration there. I did just find a question or an answer to the question that was asked previously about HSAs. There are no RMDs, required minimum distributions on HSAs like there are for IRAs. So great question, Les, and thank you for asking that. Any other questions out there? Feel free to use that chat. There's a little chat button up at the top to turn on the chat if you don't have it on already. And then you can type in anything you like. If you've got a question about something that we covered before, feel free to type that in and we'll take some questions.
Yeah, and just again to back up the HSA, I love that strategy because it's the only vehicle that you get a tax deduction going in and it's tax-free coming out, assuming you use it on health costs. And so it's the only vehicle that you almost get a double advantage to it. Yeah, that's a great idea.
And people might be concerned about is it worth it to go with the lower, the high deductible health plan? You might have some more expenses with the high deductible health plan, but you got to remember your insurance costs will be less, and you got to factor in what that tax savings would be.
Yeah.
So looks like we got another question here. Mm-hmm.
Yeah. I was going to say, typically in that situation, we always say if you're healthy, have low health costs, do a high deductible plan with an HSA. If you're unhealthy or have high health costs for whatever reason that might be, you're probably going to want to get more of a lower deductible health plan. But then there's a way that we can hire the spouse in the business to get that to get a business deduction for those additional healthcare costs. So that's usually our recommendation when we're talking with clients. Healthy, do a high deductible plan, HSA. You're going to get your best bang for your buck with that.
Absolutely. We got another question here that just came through from Rupal. How does a SEP IRA work with an employee? Does an employer have to contribute for the employee? Yes. So as I mentioned, that is the one big downside. Whatever percentage you give yourself, right? If you're paying yourself 25% of your income, you have to provide that same 25% to your employees. Now, to everybody. Now, because all of the contributions are from the employer. Now, it might not be such a bad thing. If you're, making 200,000, right? 25% for you is going to be 50 grand, but your employee is making, 50 grand, then 25% for them is going to be a lot less. So, you got to kind of factor that in. But yeah, that is one of the big downsides to the SEP, unfortunately. Of course, those contributions from the employer are tax deductible. So, you will get a tax savings by making those contributions to your employees. But yeah, that's one of the downsides there. And that's one thing that makes the 401k really attractive is you don't have to do that. You don't have to offer a match or an employer contribution at all with a 401k. It does have to meet certain IRS requirements. So that's one thing you got to watch out for, but it does provide you with a lot more flexibility. Yes, a question from another participant, Les. You can hire independent contractors to circumvent that. Yes. Yeah, you can. You can have 1099. So your 1099 employees, you don't have to make a SEP IRA contribution for. However, if you're able to get away with just 1099 work, that's great. But, whether or not you can get away with that is another thing. And maybe Mike, maybe you can jump in on, when you can use 1099 employees and when you can't.
Yeah, this is a really hot subject, especially in a state like California. They're attacking independent contractors. If you've seen the news, the whole Uber thing, how Uber workers are pretty much independent contractors. Yeah. California is trying to make them employees. But outside of California, I think you have a little bit more room for flexibility. What we always say and what the IRS is going to look at and what most states are going to look at is it's going to come down to control. Who's got control over the relationship? Do you as the employer tell the person when they got to be there, what they're working on, how they need to do it? You're providing them, you're telling them what you're paying them, you're providing them with a computer and everything else. If that is the case, it sounds like you have control of that relationship, and that's going to lean towards more of a requirement to be an employee. Now, if you can somehow shift that control out and move that more to the independent contractor has control in the relationship, then you can do that. Now, with that being said, most of the times, most of these cases that come up where the IRS or state is attacking someone for having an independent contractor when they should have been an employee is if you have a disgruntled worker. So you have someone that was an independent contractor, didn't understand what that meant, didn't understand that they had to pay a big tax bill or they had to put money aside for taxes, and then they leave your firm and they go and report you to the state. That's how most of these cases come. So as long as I always say, if you're in that wiggle room where you have some control, the worker has some control, and you're not sure which way to go, I always say, first off, get an independent contractor agreement that helps solidify it a bit, and just make sure that the worker is aware of how they're being treated and that they will have to pay taxes. You're not withholding any taxes for them. As long as you're on the same page there, traditionally, if you're in that middle line, you're going to be safe.
Yeah, good thoughts there, Mike. Thanks for that. We got another question. Rupal, if I have just hired my first employee and have a SEP IRA, is there a way for me to switch out of the SEP and roll it over to another vehicle without having to make a contribution for the new employee? So yeah, you can discontinue the SEP IRA and the money can stay there. You just can't add more money. So you could discontinue the SEP IRA and maybe offer a different plan, like a simple IRA or something. I have some clients that have simple IRA and they have SEP IRA set up. So they were using the simple IRA for a while, then they decided to start using the SEP IRA, and now they're in a position where they've hired some new people and they're having to pay a lot of money to their new employees in contributions. And so they might be switching over to, change it over to offer the simple IRA for the next year. So yeah, you can change it and you don't have to necessarily roll the funds over. You can leave the funds there, like I said, but you just can't make any further contributions. Okay, any other questions? These are great questions, guys. Really appreciate those questions. If you, we've got another one here. If you hire your kids and or spouse as employees, then you could contribute to 25% of their salaries to SEP IRA for them tax-free, but FICA taxes would apply. Yes, and that's what Mike was explaining before. Mike, you want to take that one?
Yeah, no, absolutely. And, so FICA taxes still apply. So we say the only time that you would want to hire your spouse would be for retirement purposes or for health purposes. So you're definitely going to get an advantage by using those retirement funds, whether even if it's like a solo 401k or a SEP, you're definitely going to get some advantage. I would say you're going to see a better tax advantage probably with a solo 401k than with a SEP if you're looking at hiring your spouse, because you could have them contribute the full $19,500 and you could have their pay be $25,000, which in that scenario, you're really only paying self-employment taxes on a pretty small amount, but putting a ton away in.
Yeah.
So yeah, definitely, that's definitely possible. And that's the reason that we would do that. The retirement type stuff is when we want to hire your spouse. As far as kids, if you're set up as an S corporation, the hiring your kids gets a little bit complicated. So there's two ways that you can do it. You can hire them within your S corporation. If you do that, you do have to pay FICA on that money that you're paying them. But remember, that's first off, it's a business deduction, and they're paying no income taxes on what they receive, assuming they're under that $12,400. So you have two options. One is hire them in the S corp and pay FICA. The second option is to create what we call a family management company. And this gets a little bit more convoluted, so I don't want to go into it too deeply. But basically, you'd have a family management company that provides a service to your S corporation, and then you hire your kids out of that family management company. The reason being is if you're set up as a sole proprietorship or a single member LLC that's not taxed as an S corporation, you can hire your kids within your business, and the money that you pay them is not subject to FICA taxes, unemployment, federal unemployment, state unemployment, workers' comp. Most states, they elect out of all of that. So if you're set up as a sole proprietorship or a single member LLC, you can hire your kids and pay no FICA at all up until the age of 18. But with an S corporation, because it's a separate entity, now you do have to pay FICA, which is why we use that family management company to sidestep the S corp into a sole proprietorship or a single member LLC to get that benefit. So again, a little bit into the weeds there, but there's two options when you hire your kids. With your spouse, it doesn't matter which option you go with.
Now, one thing on hiring kids real quick, one thing that's really great is if you hire your kids, they can make an IRA contribution. And that is amazing. Imagine if you were like 10 years old and put, $6,000 in a Roth IRA, what that would be worth when that child is 65. I mean, the amount of growth that you could get over the next, 55 years, that's pretty incredible. And as we all know in investing, it's really all about time being, in the market. So that's a really great thing. If you can hire your kids and make an IRA contribution for them, I strongly recommend it.
And we normally say, when you can start to hire your kids, and just based on IRS cases, it's usually about seven years and older. So
Okay.
I'm sure you could probably work something out with a 4-year-old and shooting a commercial or something like that. But 7 to 8 years older is where cases have been won in the IRS. So
and one last. Oh, go ahead.
I was just going to say there was another question there. Are there any special steps to take to become an S corporation? So two main things you have to do. You have to have an LLC or corporation set up. Once that's set up, you file a form 2553 with the IRS, and that's going to be your S corp election form. If you file it within 2.5 months afterwards, after the year started or after you've started your company, you have to file a late election. They will accept it the majority of the time, but you'd have to file a late election on the form 2553. So we request to be taxed as an S corporation. Once that's done, then the only other requirement is that we have to start running payroll to ourselves. We have to run payroll to ourselves as an owner of reasonable compensation. And at the end of the year, instead of filing our tax return, our business activity on a Schedule C, we're going to be filing a separate form, which is an 1120S, which is then going to flow through to our personal return. It's still going to flow through, and we pay taxes personally, but it's a separate formal business return that we'll have to file.
Great questions. Got a follow-up here, Mike. Looks like that one's for you.
Yeah, in New York City, what do you do instead of an S corp? It depends on your situation. So we could either stick with a C corporation, that would be the hard C corporation, or a partnership, or a sole proprietorship, or a single member LLC. It really depends on kind of where your income is going to be, how much money you want to leave in the business or not. But New York City just has an additional tax that a lot of times the S corp doesn't make sense. If you can locate that business in New York State or New Jersey or something like that, and outside of the city, the viable option of an S corp comes back into play. We do have some clients with S corps in New York City too, because they operate in multiple locations. So it's not like you can't do it. It's just a little bit of a disadvantage. Rupal said, can the S corp election be made at any time of the year, or do you recommend that it be done at the beginning of the year? It can be done at any point in time during the year. You would just have to file a late election. So if we wanted to backdate this S corp election to January 1st, we'd have to file a late election today, and they can backdate it back to January 1st. The biggest thing is we need to catch up. We need to do a big payroll catch up, a W-2 payroll catch up now to catch up for all those months that we missed. Which is possible. Anybody that has a taxable liability, $50,000, $60,000, $70,000, $80,000, it definitely makes sense to backdate that and do it for 2020. And so that when we talk about a catch-up payroll to get you caught up, you don't necessarily have to pay yourself. So let's say your payroll is going to be $50,000. You don't necessarily have to send a check today for that $50,000. What we can do is we can just take some of that money you already took, move it into wages and salaries, and then just pay the taxes on it today. So we don't necessarily have to write yourself a check for that salary. We're just going to move some draws that you already took into a salary and pay taxes on it.
Good deal. Good deal. One thing I wanted to mention about hiring your kids and making an IRA contribution is that IRA money doesn't count against them for financial aid in the future. And you can take money out of an IRA to use for educational costs, for college costs. With the traditional IRA, you have to pay taxes, but there's no penalty. And with the Roth IRA, the contributions are tax-free and they just pay taxes on the earnings. So that can be a nice way to do some college planning too, that might be a little better than the 529 actually. Yeah.
Another cool thing about that is that you could potentially pay your kids even more money from your business because the $12,400 is a deduction, is a standard deduction. But if you're now taking a potential traditional IRA or something like that on the back end, you could pay your kids $18,000. They're going to have a traditional IRA that's going to reduce their taxable income to $12,000, which the standard deduction is going to wipe out completely. So, if you're looking at something like that, you could even pay your children even more where they're still paying no taxes on it, but you're still getting a full deduction on the business side.
Pretty neat. That's pretty cool. Thanks for sharing that, Mike. Now, if you want to connect with either of us, our contact information is up there. You've got Mike's website and email, and then harmonizely.com/M Jesowshek if you want to schedule a call with Mike. And then you've got my information there too. I'm offering anybody on this call a free 30-minute review to look at their retirement accounts. And I'm sure Mike would offer a similar review to anyone who's on this call. Just as a thank you for watching today. Mike, anything you want to add?
No, that sounds perfect. I really enjoyed the time today. I think this is some good information, especially as we're coming into the end of the year. Still time to implement a lot of the stuff. So something to consider.
Absolutely. Well, thanks everybody for joining us today. We hope that you really got a lot out of this. And like I said, feel free to connect with us on LinkedIn, the website, the blog, the podcast that Mike has going, and the Facebook group and all that good stuff. And look forward to hopefully talking with some of you, and it'd be great to help you out.
Awesome. Thanks, guys.
All right, guys, take care and have a great day.